In this video, we're going to be discussing transforming your life financially by trading the SPX short term. At the Dorian Way, we consider short term 0 to 14 days to expiration, or DTE.
Please subscribe to our channel. Happy trading!
So if you're doing stuff that is 0 to, let's say, 4 DTE, then we consider you need to be an expert, right? You need to be excellent at it. Not necessarily an expert, but definitely excellent at the process of short-term trading, because you have a lot more gamma risk. You have gamma risk, period, if you are trading things that are within 0 to 14 days. But the closer you get to expiration, the more gamma risk you have. Gamma risk is how fast delta is changing. And delta measures your directional risk. So gamma is measuring how fast your directional risk is changing. So delta measures two things. Delta is one of the four major option Greeks, and gamma is one of the four major option Greeks as well. But delta is the most important option Greek. It measures your directional risk, and that's what we're talking about right now, based on how fast that directional risk is changing. But delta also measures your probability of success, and we'll touch on that a little bit as well in this video. But what I want you to understand is that you can literally transform your financial future by trading SPX. You can transform your financial situation, not just your future, but your current situation, by trading the SPX. You can do it 0 days all the way up to 14 DTE with short-term trading. You can also do a bread and butter, but this video is focused on short-term trading. So we're going to break down a 5 days to expiration trade. We believe if you are only going to be good at this, it's better to do things that are like 5 to 14 days to expiration, because it gives you a little bit more time, a little bit more wiggle room to see what's happening with the market. When you're doing a 0 DTE trade, you have all that risk within that same day, right? Things that go on, it's hard to make adjustments perhaps, and so forth. If you do a 1 DTE trade, for example purposes, you have overnight risk, and something could happen and you're not able to adjust fast enough overnight. So when you're doing something that's 5 days to 14 days, then you eliminate that kind of overnight risk. You'll still have time to fix a trade, or decide if you're just going to take a loss at a 3 times loss, and so forth. Not this 100% of the time, but it's going to be darn near close to that when you're trading things that's 5 to 14 days to expiration. So let's break down this 5 days expiration. This is an option chain, and if you don't know what an option chain is, then you need to study a lot more before you start doing these short-term trades. You want to do stuff that's longer term if you don't understand the option chain well enough, or understand the basis of options well enough. So in this video, we are assuming that you have some really good knowledge of options to this point, and this is why you are doing short-term trades. This is something that we wanted to introduce you to, because you understand options at a level that you will get this. You will be able to be successful making short-term money and transforming your life. If you're new, it's not going to take you 4 years to get this, right? But you're not going to learn it overnight. But if you're doing the Dorian Way, you'll feel significantly more comfortable in trading options after 3 months. And after 6 months, you're going to be rocking and rolling with these type of short-term trades, 5 to 14 days to expiration. All right, so let's jump into this. We have the 5 days to expiration. You can see this here on this option chain, and this is going to expire on May the 5th. Please note that the market is closed right now, but we're showing you this demonstration. But this is a real live type of situation, though. Just even though the market is closed, this is a real type of scenario that you will experience every day trading the SPX. All right, so what we want to do is have a super high probability of winning. Right? We want to have something that's 85+% chance of winning, ideally 90+% chance of winning. And the way you do that, you base it on deltas. So if you were going to do something on the put side and you were going to do a 5 delta, then that would indicate that you have a 95% chance of winning on the put side alone. So in this example, if we go and we sell the 40.15, then this is basically having a 94% chance of winning, because we're selling at this 6 delta on this put side. So what we're going to demonstrate is a 30-point wide put spread in this example, and then we're going to turn it into an iron condor. So if we did a 30-point wide, we'll be buying the 39.85. And just on this side, we're collecting $100, okay? $100 before fees and commissions. So this is not bad. If you hold to expiration, you'll win about $100, and that would be a nice return on your capital, and you will have another $100 in your account, okay? And that's pretty powerful, to be able to supplement your income, to transform your life with being able to do this. And this is just one contract, right? This is just one contract. So this is the put side. So if we go over to the call side, And let's just say we do a 5 delta at the 42.95. So we sell this 5 delta, and then we also do a 30-point wide spread and buy the 43.25. So this is a 30-point wide spread. We're collecting now a total of 205, and so $205. If you divide that by the buying power that's required to hold this position, then you are getting about 7.3% return on your capital if you hold this to expiration, meaning that you take this all the way to expiration 5 days from now. If you do what we recommend, and that's just getting out at 50 to 60%, then if you get out at 50%, then you basically have a 3.7% return on your capital in 5 days, which is pretty phenomenal. Okay? So when you're doing this kind of trade, you're focused on the expected move, and you're trying to be at least 2 times away from the expected move if all possible, right? So on the TastyTrade platform and on thinkorswim and most option trading platforms or that specialize in option trading, you'll see a expected move in the right corner of the expiration period. Once again, this is 5 days expiration. So this expected move is 65, 66. So if you take 66 times 2, that's going to be about 132 points. That is expected move, plus or minus, right? It can go up 132, it can go down 132. Doesn't mean it can't go 200 points within the next 5 days, right? Or 300 points. What it's saying is that 68% of the time, or one standard deviation of the time, the market's going to expire within this 132 point range from its current price, right? That's what it's currently trading at right now. Okay? So if we take that and we look at where our put side is at, right? And we're at the 40.15. So we take 41.69 minus 132. That's going to take us to the 40.35. So on the put side, we are 2 times the expected move away. Okay, we are more than 2 times the expected move away. On the call side, if we take that 41.69, we're just looking at this number up here where it's currently trading at, right? And we're going to add to that. We're going to add the plus 132, and that's going to take us to 43.01. So we're very, very close on the call side. We're not exactly 2 or 2 times the expected move, but we're very, very close. You can call that semantics. So this is the trade that we want to do. TastyTrade is saying you have about a 92% chance of winning at least something at expiration. If you get out at 50%, TastyTrade is saying you have a 96% chance of making at least 50% on this trade. Now, that's not a 100% chance, but that's darn near, right? So this is the type of trading that can transform your life. You can have a supplemental income that can really transform your life, that you can consistently count on. You have a 96% chance of winning 50% of this $205. That's pretty hot. You have to understand the power of that. And if you did 2 contracts, right, how would that look, right? If you were able to do 3 contracts, how would that look? We don't encourage you to go willy-nilly on this because you don't want to be fooled by probabilities or randomness. You want to understand that this is not a 100% chance. So you want to make sure that you're losing no more than 2% of your account if you have a loss. You do not want this to go to full loss, because a full loss would be basically just under $2,800. So you have to have some stopping points, right? So at the Dorian Way, we teach 2 different ways. You can get out based on a 3 times stop loss. So that's basically here. You take that 205 and you times it by 3, then you're going to get out when it's trading at 615. Okay, when this whole spread is trading at 615, you're going to say uncle and get out of trade and say, okay, that was the 4% of the time that I just didn't win, right? I just didn't win at that situation, so I'm just going to move on. But you want to make sure that 3 times the amount you receive is not more than 2% of your account, right, when you're doing these type of trades. Now, if you do our second way of adjusting, we have what we call zones. We have a green zone and everything is okay. We have a yellow zone where you need to be a little bit more cautious, a little bit more vigilant. And then we have a red zone where you're on red alert. You need to make an adjustment at that point, right? And so we teach you how to adjust these to give yourself even a higher probability of winning. Things such as rolling the trade away, as we call it on the Dorian Way, doing roll ups that you've probably heard of before, and then roll outs, right? So you have a number of different ways you can manage this trade. The easiest way is 3 times the credit you receive, but you'll have better probabilities of winning if you learn how to adjust. And we teach that at the Dorian Way. All right, so with this trade, this is how we would set it up. And if we looked at how far we were away from at the money percentage wise from this put side, so if we just do the percentage calculation, you got 415 minus what it's currently trading at divided by what it's currently trading at. So you take the 415 minus 4169 divided by 4169, that is about 3.7% away on this put side. And then if we go to this call side and we do the same kind of concept and we take this percentage here and we say, all right, so if on this call side we take the 42.95 minus this number here divided by this number here, that's the at the money price, what it's currently trading at. So the 42.95 minus the 41.69 again divided by the 41.69, then you're going to get about 3% away on the call side, right? So not bad. That's big. A market's moving 3% or more than 3% in a week. Overall, that's a really big move up or down. All right, so this is how you can transform your life financially by trading the SPX with short-term trades. We're showing you the 5 DTE trade here. If you have any questions, please leave a comment, good or bad, in the comment area, and we hope to see you in the next video. Thank you for watching.